Guys, good morning. October 31st, 2019, Thursday. Let's rock. It's going to be a beautiful day. Here's what we got going on. Miss and squeeze to continue. The APEC meeting in Chile conveniently canceled. Trade deal worries resurface, but don't worry. No market crash in no side here. VIX is trading between 12 and 13 and likely to maintain its level despite showing signs of a bottom here. Now, solid results from Apple and Facebook to keep tech sector from the sell-off today, and both stocks are likely to move higher. We're going to show you exactly how to trade them today. Now, but there is actually a better trade than Apple and Facebook. Overall, there's some interesting things that developing on the charts, the possibilities for today under the bull flag or a move 11. We're going to give you the answer of exactly what will take place. Now, cloud sector is bottoming. Is it time to buy now? Some of the trades we're going to discuss in detail is OLED, WWE, Amazon, Equix, World, and many others. So here's what we got going on. Every day in the last 2 weeks when the market actually opened lower, it finished the day higher. So anytime you see VIX in the range that is right now, 12, 13, 14 range in the VIX, if the market opens higher, it's actually negative. If the market is actually opening in the red, it is highly bullish because banks are buying this dip. So we're seeing that this behavior is likely to continue. So anytime, basically think of this. If you see the market open in the red like it is positioning right now, the futures are down about 10 points pre-market. From red, we are going to finish in the green. This is a characteristic of this miss and squeeze type of behavior that is dominating the markets right now. So the trading tunnel has narrowed substantially, pointing to a further breakout higher. Just a few days ago, we were focusing on this orange dust right here, which represented a level 3015 roughly. We finally made this bullish flag here, broke above that level, set a double bottom when the market could actually win substantially lower. Yesterday, it held the level of 3025 nicely. So your area of near support is going to be 3015, 3025. However, the market could officially move to the moon. It's likely to retest the levels of 3055 right here. We're likely to retest that at some point today. And then it's going to be a question of whether they're going to form a move 11. If overall, yesterday was a move 10, if you combine it with the pre-market action, we're kind of getting this move 11. So that's the question of the day. The predominant pattern has been the bullish flags, but we're seeing some of these 11s resurface, and we're going to be monitoring them closely. But so far, for the purpose of trading today and tomorrow, everything is open for the bulls. So the idea is to implement two strategies, two simple strategies. We're going to break down in detail for you. We're likely to see a bullish move 7 behavior in both Facebook and Apple today. So basically what it means is buy the intraday dip. It will appear as they are clearly way off their highs after reporting the results yesterday. We're going to take a look at both charts here shortly. That there's going to be a time frame in the day where they're going to be selling off. They could be selling off right at the open. People are going to come in and try to lock some profits here. Now, the key thing is to not mix this move of a move 7 with a move 2 or a possible 11 formation as we have seen in MOH. Someone actually commented yesterday in the group saying, hey, MOH, is it time to reverse the bullish trade that we explained in the daily video yesterday into a short position? The answer is clearly no, because when stocks are coming off the miss and squeeze formation, you really just want to stay bullish. They're not going to drop. The worst case scenario here is sideways trend. Therefore, the strategy of buying in the money or near the money is the best way to go, opposed to buying calls way out of the money. So as it may appear to you that Facebook is selling off, if you're looking to trade Facebook today, there's going to be some sell-off intraday. Your goal is to not buy puts at that moment. Your goal is to buy calls and catch the lows of the day intraday. That's how you will make money. The same thing applies to Apple. There is going to be some profit taken in Apple, but your goal is not to panic and turn into a bear buying puts here. Your goal is to nail the lows of the day in Apple and actually buy calls at that moment. That is the strategy that will pay. Now, best strategy is basically buy next week calls. Why? Well, because stocks go higher substantially slower than they drop. So as it may appear, here's clear move 11 formation right after Apple's announced earnings. Quick move to 252.5, followed by a drop. So far, pre-market, at the point I'm recording this, it's making a move to formation, basically a slight pop followed by a drop. Ideally, we'd like to see Apple sell off to this level of 244, possibly 243. That would be the lows of the day. And from here, we could see Apple recover. So don't necessarily buy Apple calls right at the open. Wait for a pullback, and that's what's going to allow you to actually lock some gains. Try not to buy at the highs of the day. To help you understand, for those of you guys that are new, the difference between a 2 and a 7, it's going to look like overall, right, the earnings are positive on both stocks, they're moving higher, but people are going to come in and take profits. It's going to look like they're both dropping. Your goal is to capture this moment right here, the lows of the day. This is the time where you're going to be looking at your screen and you're like, hell no, there's no way I'm buying calls in this shit. Leonardo with his damn analysis, you know, trying to be a bull where I need to be a bear. And the moment you start thinking that, guys, that's going to be your perfect entry point, because that's actually going to coincide with the lows of the day when everything inside of it is going to scream to buy puts. You should be buying calls. And then what you'll see is there may be a couple of touches on the lows of the day, and then both stocks will grind higher, and they're likely to continue to move higher next week. Now, don't expect $20, $30 moves higher. Clearly, those moves, they are already to the upside, and so don't expect some crazy gains on this type of trades. Now, we're going to show you the two type of trades to focus on, and there is a better way to trade some of these earnings this season. So basically, the idea is you want to buy Facebook calls on the dip. In Facebook chart, after the earnings, you can see a resemblance of a move 11, but what they do is they buy the dip and they carry the stock all the way to a 200 level. So today it's going to be important for Facebook to actually break above 200, but as soon as the market opens, they actually sell off. Basically expect this behavior to continue intraday. So it could pop, sell off. Your goal is to buy it right here, because that is your move 7. Pop, drop, they buy the drop, they buy the dip, okay, and then they move the stock higher. So expect this. Pop, drop, buy, the stock moves higher. Ultimately, we'll break 200 level by next week at some point. So you could trade Apple or Facebook today, guys, but options will be priced higher, right? Because the market already expecting, hey, they both reported good earnings. They're going to be moving higher. So these options on the call side are going to be priced substantially higher compared to, let's say, Google or Amazon. So when you may be pulling up your options, you're like, well, no, Leonardo, are you kidding me? Of course, Amazon and Google calls are going to be much higher. Yes, they are, but I'm not talking about the actual cash value that would be put in. Clearly, the options on a, you know, $1,700, $1,800 stock and on a $1,200, $1,300 stock are going to be much higher than options on a $200 stock. So we're not talking about the actual price that you're paying, but what we are trying to say here is the options in Google and Amazon are going to be priced lower in relation to the remaining move that these stocks could be making. So while you could get a, you know, $4 or $5 move in Facebook or Apple today, you could actually get a $30, $40 move in Amazon. So when you're looking at the cost that you're paying for the call option in relation to the type of move that these stocks could be making today, we definitely see a much bigger opportunity to profit in Google and Amazon calls as far as the percentage of the returns, but the trade is based on the same type of idea here. So you take your shot, Apple, Facebook, Google, Amazon, but we personally believe that Amazon and Google will do substantially better. Now, in this stupid market environment, there's two main type of trades that I want you guys to focus on, because those are the trades that will generate you returns. Shorting the market right now when this state of stupidity does not make sense. However, for those of you hardcore bears, I will reveal two trades on the short side at the end of this video. So buy the dip is back. We clearly seen when this VIX is below certain levels, 13, 14 especially, institutions are more likely to buy the intraday dips. So in relation to the earnings, the companies that are reporting earnings, a number of them are automatically going to open higher. So what you want to do with this is you want to partake in them, because, you know, clearly if institutions are buying them on heavy volume, they are going to be going higher. Now, some of them may be stalling out. So there's some issues associated with buying the dip, because the upside potential may be limited, and therefore you could experience limited returns on this type of trade, buying intraday dip type trade. So in other words, the type trade of one is when something goes higher after the earnings report, we're buying calls, but understand those are not the trades that will generate you 500, 1,000% returns, because everybody wants to take a trade like that. Why? Because it's the easiest type of trade to take. When things looks like they're going to go higher, all you got to do is buy calls. Well, those are the trades that a typical trader would take, and they don't generate a ton of profits, okay, because most of the move has already taken place. So you're just buying something after it literally made half of the move or 3/4 of the move, or maybe almost pretty much every move, and you could be in a position where you're buying calls closer to the top. Where you're buying calls close to the top and the stock starts side trending, that is not going to make you any money. Now, what I'd rather have you focus on is the trade that we have been explaining that we call miss and squeeze. Now, miss and squeeze actually is a TRO, a trade reversal type trade, and will produce much higher returns. To help you visualize this, the trade number one is going to be, here's the company announcing earnings. It moves higher. It's clear to the market participants that the earnings are good, everything makes sense, institutions are buying the stock. Okay, so what a lot of traders would do, they would try to buy this thing at the open. Don't do that. In such conditions, you want to wait for the pullback. Here's going to be your entry, and then a lot of times the stock will resume the move. Now, understand this, initially it already starting higher for the day, so your profit opportunities are not going to be very good. You may be right about the direction that, yes, they are going to move higher, but it doesn't guarantee that you will lock some substantial gains, because there is always a probability that this thing could start going sideways. In other words, it could pop here. If you don't close your position, it could move a little bit lower, and it could just do that for the rest of the day. So there's definite issues and limitations with this strategy. Basically, options are going to carry substantial premium because everyone's already pricing the positive news. And number two, half of the move, or more than half of the move, or the big move higher, has already taken place, okay, which clearly, you know, limits your possibility of making a killing on such trade. And also think of the possibility of the sideways trend that could kill your options valuation as time progresses. Now, the advantage to timing and trading the type 2 strategy, which would be the trend reversal type strategy, is basically you want to identify the companies that are actually reporting misses. They miss on their earnings. So somebody actually asked me a question, well, Leonardo, what's the damn difference between buying the dip and buying, you know, the miss and squeeze? Well, buying the dip is, you know, similar to this. And buying the dip could be also when something drops, not necessarily just the intraday drop when overall something is moving higher. But this particular condition we're describing is a common trend in this market environment, meaning that a company typically would drop by reporting a miss either on earnings side or on the sales revenue side or on further guidance side. Okay, the only exception to this is, and make sure you clearly understand that, is we're not looking to target this bullish move on the call side on companies that miss on more than one criteria. In other words, if the company is missing on earnings but it beats on revenue, this is a good candidate for a squeeze, for a miss and squeeze type strategy. If the company misses on revenue but it beats on earnings, this is a good candidate for a miss and squeeze type strategy. But if the company misses on earnings, misses on revenues, misses on forward-looking guidance, guys, those are still great candidates to short even in this clearly stupid market. So your entry level basically is gonna be right here when it becomes clear to market participants that actually the earnings report is not as hot as everybody is expecting. The company is missing on some numbers. Okay, so the options on the call side are going to be cheap. So you're not going to be paying the premium. You actually can get a bargain while these things are dropping pre-market or right at the market opens, okay? So entire big move is about to take place. So your entry is here. It captures you the rest of the move. And a couple of examples I'm going to show you to help you understand this, guys. Example number one. So a couple of videos ago, we basically suggested NXPI call side trade in the 13 market move daily video. So NXPI reported earnings bit, just kind of like Facebook and Apple did. Similarly, it moves higher. We say, hey, buy this 110, 115 calls. and the expectation of the stock possibly touching 120 level. So it stops at 118.5. So yeah, if you would have gotten on the trade right here, as we recommended on the pullback, a slight pullback you see right here, that was your entry, then yeah, you would have made a little bit of money. Nothing huge, but it would have been a profitable trade. Now notice the danger side of this. If you would have always traded in this trade, the stock now is trending sideways between 116 and 115, then clearly your options would have been decayed right here. So this is just a tiny little profitable opportunity. Now compare it to this, 500%er that we suggested yesterday in the 13 Market Moves daily video. Basically, we recommended this level to come in. We specifically mentioned as long as MOH opens between 110 and 112, buy calls, because historically also this stock had a high probability of a reversal as well. But basically, MOH missed on one of the criteria, so it was a good candidate for a miss and squeeze stop opportunity. And as long as you would have gotten in right at about in the first 20 minutes of the trading session, you would have captured the entire move to 124 area. Actually, at one point it traded just above the 124. So this type of behavior highly resembles the behavior of Amazon and a couple other charts I'm about to show you guys. So understand that this is a TRO. This is a trend reversal type trade. You want to jump in on these only if the company misses on one of the earnings criteria during the earnings announcement, but not if it's missing on more than one. It would make it a poor candidate for utilizing such strategy. Now, clearly, Amazon missed on one of the criteria, and here we had the miss and squeeze on Amazon. And again, I wanted to bring this chart up because we think as long as Amazon clears this level of 1788 today, it could shoot up easily to a level of 1810, 1820, possibly 1830. So there is an easy $30, $40, $50 move in the making that we're seeing today, which is definitely going to be a much larger move and will produce much greater results than trading Facebook or Apple for that matter. So if you take a look at the pre-market action, okay, this behavior of miss and squeeze continues on Amazon. It missed and squeezed out the short sales after earnings. Now it's positioned for a $30, $40 move higher today. We're seeing the same pre-market condition. The stock is down on low volume, so this could be reversed rather quickly, and you could see the stock substantially high by the end of the day. Now we mentioned, is it time to buy the cloud stocks now? Now was actually one of the recommendations we suggested a few videos ago. In our 13 Market Moves daily video, and we at the time was trading about 240, 245. We suggested buying 245 to 50 calls. So far, the stock has not done a ton, but we still see it easily running up to about 260 levels. So just keep buying now calls, because if Amazon breaks out higher, you will also see a big move in now today. It looks like the institutions are continuing to accumulate the shares before a bigger squeeze here. Now, possible miss and squeeze target at the open is WWE. World Wrestling Entertainment misses on one of the criteria at the earnings report, and we're liking the 55 strike call. It misses on revenue, actually bids on earnings, so possible candidate for a miss and squeeze formation. You could see maybe a move lower to 55, 54 level, followed by a move higher back to the 62, 64 area. So miss and squeeze on this one. Twilio, we think the big move is done. Clear characteristic, all the tech stocks are showing this miss and squeeze. So Twilio misses badly on earnings, but bids on revenue. Stock drops all the way to 86, followed by the squeeze to 101. Yeah, this could possibly contain itself all the way to 104 area, but overall we're seeing high probability of the sideways trend, therefore avoiding this trade. 320, 330 calls at open creates great opportunity because the big move here is still very much in the making. If you focus, this stock is actually able to escape the death cross. Here's the death cross, doesn't drop a whole lot, just a tiny bit, and now it's working its way there. It looks like they've been consolidating, buying more shares right around here. We're targeting a level of 344, 350, 360 here. The stock trades so far at 325, so there's plenty of room on the call side on this one, guys. Another stock defies the gravity of the death cross, OLED. As you can see, the stock was heading into a death cross formation what we call a death hook. And now, after the earnings report, it's looking like it's ready to open about 195 level. Our target on this stock is going to be about 200, 210 area. This is where we're targeting to take profits after buying the stock on the dip. We think the dip could come in maybe to a 190 area, so that would be our entry right here at 190 on OLED, buying the 190 calls. With that said, this move higher could easily break out to a 205, 210 area. That is where you want to come in and collect the gains. This one, we just want to buy the damn puts on this. EQIX puts missed on everything. The stock is going down. 570, 560, 550 puts. World, 130, 120 puts. The company missed on absolutely everything. We like it as a short. Long-term chart looks horrible. This stock is going down. Get in at the 132 level, get out at about 110, nice and simple. Yesterday, October 30th, Wednesday, was a move 10 formation. Move 10, here's how we track it right at the 2 p.m. As we said, the market was going to move lower, followed by a move higher. That's exactly what has taken place. 2-day sequence is 11-10, bearish move, followed by a bullish reversal type move 10 after the Federal Reserve announcement. 5-day sequence 5-8-7-11-10. Basically, the bull flags dominate the 5-day sequence, and that trend is likely to continue. Next market move, that is for today, October the 31st, is move 4, 8, or 12. Basically, where the market is going to open in the red and finish overall in the green, or get pretty damn close to it as if we get a move 12. VIX resumes the downtrend, so it pays to buy calls in the money, near the money. VIX is fighting pre-market after the rate cut. VIX yesterday drops all the way to 12.19 after the news of a trade deal, having some negative news this morning. The VIX spikes back above 13. We think this action is going to resolve to a move lower in the VIX. VIX hitting a level of 12 at some point today. And this could be the bottom in the VIX. At this point, we may look at a bunch of other charts and reevaluate, but so far, we want to stay bullish, thinking that VIX is going to reverse this bullish action pre-market. Key takeaways: miss and squeeze dominates earnings. Focus on buying the dips and companies that are up after earnings, targeting them on pullbacks. And the best opportunities are going to be the miss and squeeze in companies that miss only one criteria in their earnings report. MOH calls, Google calls, Amazon calls, BYD, and all the trades were described in this video. Have an awesome trade day. I'll catch you guys on the next trade tomorrow.